Thank you, Mr. Chairman, and I will probably be pretty brief, but it's interesting as we sit here and talk about the Volcker Rule, and I think history will reflect that probably the most significant part of the Volcker Rule in terms of its import on the markets has been the anticipation of its implementation. Because leading up to the rule actually being released and now as we debate its implementation, we've seen, as some of my colleagues have pointed out, the divestiture of Volcker-like trading, proprietary trading. But now we're on the cusp of seeing what happens from a theoretical perspective of trying to eliminate proprietary trading to the practical application of the rule. And Mr. Benson, you've explained some of this in your opening statement, and you've raised this, and some of my colleagues have talked about it in terms of when you have conflicts between any one of the regulators. And my first question to Mr. Benson is, have the regulators given you any clarity as to how they're going to resolve conflicts in opinions as to the application of the Volcker Rule?
No.
None whatsoever?
Not yet, no.
Would that not be somewhat significant at this juncture as someone in your position as to what to anticipate?
Well, I think that really should be their next step. I think they need to, and I think this, trust preferreds is a good example. And Mr. Gantz raises having to go see 5 regulators. So.
And Mr. Gantz, I appreciate your background in this, and I wonder if you could speak to the difficulty and complexities of the legal complications of having the conflicts in rulings between regulators, and whether there is any recourse or due process for those who are affected by it.
It's been very difficult to deal with the interagency issue. We've been focusing mostly on the Volcker Rule and on the risk retention, and in each case it's either 5 or 6 agencies, and there's no real roadmap.
And there's no due process. I mean, what if a trader needs to appeal a ruling that's adverse to their position, but yet another regulator has sided with them? I mean, you're damned if you do and you're damned if you don't. I mean, quite frankly, that's a very unusual situation to be in.
It's not easy.
Okay, good. Well, I appreciate that. Back to market making. I think there is an ambiguous area that I think we're going to have probably more hard times trying to wrestle with as time goes on, because I think you've got to look at trend analysis, but it gives such a great deal of discretion to the regulators to determine whether there has been an investment based on market making or rather just for self-serving proprietary trading. In fact, Jones Day, in their initial reaction to the rule, stated that troublesome questions include the effects and consequences of a change, sudden or otherwise, in these reasonably expected near-term demands or in market cycles and times when market making can be suspended. Back to you, Mr. Benson. Have the regulators given any guidance as to what will constitute market making?
Well, Congressman, in the final rule itself, they certainly lay out the compliance framework and systems that they expect the firms to use, including the metrics and what they will rely upon. What's not clear is whether they will rely upon them uniformly or across 5 different jurisdictions. And it's not clear how these will work. Obviously, we'll have to go through that process.
And as a litigator, I can only say that this is a wonderful thing for my profession, because it will be a relief act for those out there trying to help interpret what the application will be among several agencies. Finally, I want to talk briefly about the investment in sovereign debt. I think when these regulations are being decided upon, there must be a consensus that there's infinite capital out there, and I think we can all agree that there's a finite amount of capital, and that capital will seek the path of least resistance and the highest rate of return. And now that we've allowed for the investment in sovereign debt, what I foresee, and Professor Johnson, I want to get your opinion on this, is I foresee that the capital will leave the domestic market and go to foreign investments, because there is no need to prove that you're innocent before guilty by way of the Volcker Rule, and instead you can invest in sovereign debt and not have to worry about investing in domestic trades. What's your opinion about that?
No, I don't think that's correct, Congressman. Obviously, investors are looking at risks, they're looking at returns, they're looking at a strong rebounding U.S. corporate sector. There's a lot of concerns, legitimate concerns about sovereign debt around the world, and those are the primary drivers of market attention.
I agree with you.
spread.
Market trends can be analyzed over time. They can be forecast based on that. But the one element that I think happens to be hardest to manage is the impact of regulatory involvement. And I think that's what we're going to see with the Volcker Rule when I, as a banker, now have to prove that I'm innocent until proven guilty. And instead of going through that compliance, instead of going through that regulatory morass of having to prove my innocence, I would rather invest my assets on behalf of those whom I have a fiduciary duty to into foreign debt. And I think that's what we're going to see happen, and I realize my time's up, and I yield back.
Time, the gentleman is